Hello everybody, this is Lara at pureelliottwave.com with a video analysis of Ethereum for you on 9th of April 2022. If you want to click on the link below in the description box, if you're viewing this on the YouTube channel, that will take you through to my website where you can see a full text analysis with charts if you prefer to not watch video like me. My conclusion for Ethereum is the bull run is most likely to have begun, but I'm not fully confident in that because I'm not seeing the strength off lows that I would prefer to see for full confidence. So I still have an alternate wave count which allows for the bearish pullback to continue before the next bull run for Ethereum begins. But overall, my bigger picture analysis for Ethereum remains very, very bullish indeed. Elliott Wave analysis first, classic analysis last. And in this analysis, I'm going to take a look at the past depths of bear markets for Ethereum and the past lengths of bull runs for Ethereum compared in Elliott Wave terms to their prior actionary waves. This is the full price history of Ethereum. From this low, where my wave count starts at 0, to this high, this upward movement subdivides perfectly as a 5-wave impulse. It's labelled primary 1, 2, 3, 4, 5. There's alternation between the triangle of primary 4 and the double zigzag of primary 2. I'm noting the wavelengths of the actionary waves on this chart so we can get an idea for future analysis of what kind of targets we should be looking at. Within cycle wave 1, primary 3 was 19.36 times the length of primary 1. That is not a Fibonacci ratio. I'm just noting how long primary 3 was in relation to primary wave 1. Primary wave 5 was $81.51, greater than 2.618 times the length of primary 3. This is a Fibonacci ratio. If the variation of a perfect ratio between the two waves is less than 10% of the last wave, then I consider it to be close enough to have been useful in trading or investing terms, and so I consider it to be exhibiting a Fibonacci ratio that's useful. And here, this length of 81.51 is less than 10% the length of primary wave 5, so that's the judgment I've made there. Within primary 3, we have some structure at intermediate degree to analyse. Intermediate 3 was 18.24 times the length of intermediate 1, again not a Fibonacci ratio, and intermediate 5 was 7.68 times the length of intermediate 1, again not a Fibonacci ratio. That should read intermediate wave 3, not intermediate wave 1. Intermediate 5 is longer than intermediate 3. This is a semi-log scale, so they look close to equality in length, but they're actually not in terms of actual distance price travelled. So the thing to note from this analysis here is the third wave is a lot longer, 19.36 times the length of the first wave, and the fifth wave is longer still than the third wave. The longest, strongest wave is the fifth wave. Now we're talking about distance travelled in price, the actual arithmetic difference, not what it looks like on a semi-log or logarithmic scale, and that's really important because it's those actual price points that you use to make your calculations for your wavelengths, and the difference in how far price travels means the difference in your profit. So for investing purposes, it's those arithmetic calculations which really are the most important. If you were just to consider logarithmic or semi-logarithmic, you'd ignore the fifth wave, and that's where the profit is going to be found because it is so much longer than the third wave, which is also already longer than the first. I'm also noting the depth of the bear market so we can get an idea of volatility and what kind of volatility we would need to ride out for a longer term investment, because I'm doing this analysis, let's be honest, for my own purposes, and then I'm sharing it with you. Primary wave 2 was a 0.74 correction of primary wave 1. At its deepest part, primary 4 has intermediate A of the triangle. This was 0.68, the depth of primary wave 3, and cycle wave 2 was a 0.94 depth of cycle wave 1. It doesn't look You can't tell that it's that deep on a semi-log scale, but in terms of actual pull down or drawdown in terms of price, it was a 94% correction in market value almost. That is a huge drawdown that you need to ride out in terms of volatility if you'd bought that back down here. One of my basic approaches for investment in these cryptocurrencies is to look for an impulse and a completed following correction, which should be very deep in the 80 to 90% range. If it's deeper than that, then I'm really confident it's over. And then to look for the resumption of a bull market, to see strength off lows, and to buy while I'm still in this first wave price territory. So anywhere in this area is still a decent buying opportunity. For Ethereum, for my purposes, I'm too late. I've bought down here. I'm just going to hold on for the end of primary 3 and try and see, depending on how long it takes and what stage of life I'm at, whether or not I want to hold on for primary wave 5. So that's my own personal investment approach and why I'm doing this analysis. This big wave count has cycle 1 and 2 complete and cycle 3 incomplete. Incomplete is a 5-wave impulse. That's the only Elliott wave structure it may subdivide as. I'm having a general stab at a target, and I don't have a lot of confidence in these targets. I'm just trying to get some vague idea of how long it could possibly be. If cycle wave 3 exhibits an extreme Fibonacci ratio of 11.09 times the length of cycle 1, a target would be 15,860. That may not be high enough though, because when we look at the third waves within cycle wave 1, they're a lot longer than 11.09. This one 19.36 and this one 18.24. So this target is probably not going to be high enough. But I want to use Fibonacci ratios for targets to get some idea of where it could be. Within cycle wave 3, now the difficult part of the analysis comes from this low to this high. This looks really good as a 5-wave impulse. The difficult part and the question to answer today, is this bearish pullback over, which I'm labeling primary wave 2? If it's over here, it's just 0.57 the length or depth of primary wave 1, which for this market could be considered rather shallow, but when we consider, for normal cryptocurrency, primary degree second waves would be considered very shallow and so incomplete. But when we look back at the price history of Ethereum, here we've got 0.68, here we've got 0.74. So here 0.57 is more shallow, but within the ballpark of acceptability for this particular cryptocurrency, so I will accept it. We'll take a really good look at classic analysis about this low to try and draw a conclusion as to whether or not it's most likely to be over here or primary 2 could continue lower. If primary 2 continues lower, which is my alternate idea, it may not move beyond the start of primary 1 below 82.8299, but it's extremely unlikely to overlap back into cycle wave 1 price territory, so not to be as deep as 80 or 90%. Let's take a look at the first daily chart, this high of primary 1 up here, weekly chart. Here's the high of primary 1. I want to take a quick look at the Fibonacci ratios within primary wave 1, because this is going to give us even more information as to what to expect for wavelengths for Ethereum. Primary 1 is an impulse labelled intermediate 1, 2, 3, 4, 5. Intermediate 4 is much more brief than intermediate 2. That is absolutely acceptable for a market with extreme volatility like this. I'm used to seeing this in commodities. I've been analysing those every day. Gold with oil once a week and usually silver once a week. I've been analysing gold every day for over 10 years. And so I'm really used to how commodities behave with their extreme volatility, and cryptocurrencies are an even more extreme version of this. What that means is third waves of commodities and cryptocurrencies tend to end with very strong fifth waves. It's the fifth wave to end a third wave 1 degree higher, which is usually the strongest portion of upward movement. Not the longest, but the strongest in terms of momentum. And that forces the fourth waves that come just before and just after to very often, not always, but very often be more brief and shallow than their counterpart second waves. And so here, intermediate 4 being more brief and more shallow than intermediate 2, which is deeper and longer lasting, is absolutely to be expected, normal behaviour for this kind of market with this extreme volatility. Like wavelengths within primary wave 1 also give us some information as to what to expect for the rest of cycle wave 3. Here, minor wave 3 is 57.97 greater than 4.236, the length of minor wave 1. That's not a very extreme Fibonacci ratio for a cryptocurrency, so Ethereum is not as extreme as many of the other cryptocurrencies are viewed. But here, minor wave 3 is a lot longer than minor wave 1 and exhibits quite closely a Fibonacci ratio. Here also, minor wave 5 is 281 longer than 1.618 times the length of minor wave 3. This is quite a big variation for investing purposes, but it is less than 10% the length of minor wave 5. Within intermediate 3, there are Fibonacci ratios between 1 and 3 and 5. So not only is Ethereum a less extreme market, but it's exhibiting more reliable Fibonacci ratios. We've just got to be aware that we have to allow for a 10% variation either way. The ratios it's exhibiting are longer than, the variation is longer than the ratio exhibited also in every case here. The length of intermediate wave 3 to intermediate 1, there is no Fibonacci ratio between these waves. Intermediate 3 is 15.32 times the length of intermediate 1, very, very long in relation to 1. Intermediate wave 5 does exhibit a Fibonacci ratio. It is 94.78 longer than 11.09, an extreme Fibonacci ratio, the length of intermediate wave 1. Interestingly, if primary wave 1 is over here, intermediate 5 is shorter than intermediate 3. Now, for a normal market, that would be expected, particularly when the third wave is such a long extension. But for a cryptocurrency, that's a little bit unusual. That's another reason to seriously consider the alternate. If primary 2 is over here, it's just a 0.57 depth of primary wave 1, shallower than the 0.618 Fibonacci ratio even. Normally for a cryptocurrency, I would not accept that, but for Ethereum, given its past relative to other cryptocurrencies, shallow bear market pullbacks, this is possible for Ethereum. I'm taking a stab for this main daily wave or weekly wave count at a target for primary wave 3. If it exhibits that extreme Fibonacci ratio of 11.09, the length of primary 1, a possible target for just primary 3 could be 55,503. Now I know this does not work with the target I have on the monthly chart. This is just a completely different stab at a target for a different wave. If this primary 3 were to get close to this kind of length, then obviously the target for cycle 3 on the monthly chart would need to be recalculated. Let's take a look at the structure of primary 2 at the daily chart level from this high here. This point here, it subdivides quite nicely as a zigzag. Intermediate A, intermediate B an expanded flat, intermediate C a long extension, exhibits a Fibonacci ratio to intermediate A. Intermediate C is 167 longer than 2.618, the length of intermediate A. I've had the very odd comment from time to time telling me that this wave count or similar wave count must be wrong because my A and C waves within a zigzag aren't close to equality. That's such a strange comment. C waves can be extended, A waves can be extended, but if you're going to see an extension between A or C, the most commonly extended wave is a C wave. That's not uncommon. They don't have to tend toward equality. That's just the most common relationship. It's less common for one of A or C to be extended, but absolutely possible and certainly does happen. It's not rare. Here we have a short A, B is an expanded flat, and within B, minor B is an expanded flat. B waves within B waves are very commonly expanded flats. So this fits really well as a B wave. From this high to this low, this downward movement fits very well indeed for a cryptocurrency as a 5-wave impulse. If you're going to try and label primary 2 a double zigzag, you'd want to label the first zigzag over here X, and then you'd have to see from this high to this low, you'd have to try and see this movement as a zigzag, and it really does look much better as some kind of impulse or part of an impulse. So I think this is best labelled as a single zigzag. I've drawn a best fit channel around it, and my daily chart here is on an arithmetic scale. My weekly and monthly charts are on semi-log scales. When you draw a channel on an arithmetic scale here, the channel is breached by upward movement, a pullback finds support, another pullback finds support, another pullback enters the channel and quickly exits, and now price is moving up and away. I've drawn a base channel around the start of this upward movement from the high of 1 to the last high, a parallel copy, well, not on the end of 2 but down here, because it beautifully shows support for these 3 daily candlesticks. Along the way up, if we see any deeper pullbacks, I would expect pretty strong support at the lower edge of this channel. This would be my expected bottom line, not the invalidation point. But technically, for Elliott Wave purposes, this is the invalidation point. If primary 2 is over there, then within primary 3, I would expect intermediate 1 is incomplete, with minor 1, 2, and 3 incomplete, with minute 1 expanded flat for 2, 3, minute 4 may or may not be over here as a zigzag, certainly could move a bit lower, may not move into wave 1 price territory below 2849.424. Note the invalidation point is here at the high of minute wave 1, not here at the extreme of minute wave 2, because the Elliott Wave rule applied here is very clear. 4 may not overlap into wave 1 price territory, and this is the edge of wave 1 price territory. When intermediate wave 1 may be complete, then intermediate 2 may be a multi-week pullback and could be fairly deep, and may not move beyond the start of 1 below 2172.3013. At the daily chart level, this is my alternate wave count for primary 2. If we move the degree of labelling within this zigzag down 1 degree, this may be intermediate wave W, the first in a double zigzag for primary 2. The double may be joined by an incomplete X wave in the opposite direction, subdividing as a zigzag, and then Y may unfold as a zigzag lower. X is incomplete though, and the reason in Elliott Wave terms, the reason why this is an alternate is X is too deep and taking too long. X waves within multiple zigzags are almost always brief and shallow. They don't have to be, that's just a really common tendency. This one is neither brief nor particularly shallow, and so the probability of this wave count in Elliott Wave terms is reduced. We'll look at classic analysis terms when we get to those charts. Within intermediate X, A and B may be complete, C incomplete, with 1, 2, 3, 4, 5. Again, 4, a zigzag may or may not be complete here, could move a little bit lower, may not move into 1 price territory. On the way down, after C is complete, if we see a trend change and downward movement, a new low below 2172.3013 would add confidence to this wave count. The invalidation point's a long way away, but just really quickly going back to the monthly chart, I would not expect primary 2 to overlap into cycle wave 1 price territory. That's not an Elliott Wave rule, that's just looking at past behaviour of Ethereum once a sustainable high is formed, followed by a big bearish pullback and price moves up and away. It doesn't overlap back into that prior high. And so for here, cycle wave 1, I would not expect this high to have an overlap. That doesn't have to be the way it works out, it's just looking at prior behaviour. Bitcoin has a similar tendency. Okay, this is the wave count we've just looked at. Now I have another alternate at a weekly chart level because you really would want to consider this. For this wave count, primary wave 3 here would be 15.27 times the length of primary 1, and so for this wave count I'd expect primary 5 to be a lot longer than primary wave 3. At 15,860, cycle 3 would reach 11.09 times the length of cycle 1. This wave count moves the degree of labelling here up 1 degree. Instead of seeing primary wave 1 over here, what if it was over down here and we have 1, 2, 3 and an incomplete triangle for 4, and then we're going to see a really long, strong fifth wave. It has to be really long because, again, back to the monthly chart, I'm sorry I'm flicking around. I hope this isn't confusing anyone. I'm trying to be really clear. The fifth wave has to be really long because cycle 3 has to move substantially beyond the end of cycle 1. It has moved beyond the end of cycle wave 1 so far, but it has to move further so that there's room for cycle 4 to be deep and remain above wave 1 price territory. So for that reason, for this alternate weekly wave count here, I would expect primary wave 5 to be multiple times the length of primary wave 3, which is already particularly long. This wave count, it looks okay, but in Elliott Wave terms there's a little problem here, and this is just based on many years of experience with triangles. If primary 4 is a triangle, the problem now is there's a couple of small overshoots of the triangle trend lines. There's a little overshoot here and there's 2 small overshoots here. The overshoots are really small when you look at it squished up on a higher time frame like this, but when you look at it at the daily chart level, they're actually a little bit too big for comfort. This is because Elliott Wave triangles have a really strong tendency to adhere very strictly to their trend lines. They are never they should never be breached. If a triangle trend line is properly breached, then your Elliott Wave triangle is probably wrong. You need to just pretty much discard that wave count. If they are overshot, they can be a little bit sometimes, but here we've got 3 reasonable overshoots. This is a much more normal test of a triangle trend line falling a little bit short. For the triangle trend lines to be overshot is rather unusual for an Elliott Wave triangle and reduces the probability of this wave count. But I like to consider multiple alternates, be open to different possibilities and not get hung up and stuck on just one idea, because then you get tunnel vision and markets will invariably prove you wrong when you do that. So what if this is right? We could have a triangle completing for primary 4. It may not move into wave 1 price territory below 361.3987, and if this unfolds as it certainly could, I will keep running this wave count alongside my main wave count, and it'll be useful in calculating different alternate targets. Once primary 4 triangle could be complete if the triangle remains valid and the E may not move at all beyond the end of C, a new low below this point, immediately the triangle is discarded, it's invalid. If it remains valid, then I'll take the end of primary 4 and use Fibonacci ratios between 5, 3 and 1 to add to this target calculation and see if I can zone in on a small range at both cycle and primary degree where I'm getting similar figures to give a small target range, and that would have a higher probability. That's my general approach to target calculation. Okay, I'm going to look at weekly and daily charts now and have a look at some classic analysis using some classic technical analysis tools, the usual ones I use. At the weekly chart level, price is consolidating, and it has been consolidating for quite a while, with support about 1700 and resistance about 4380. More recent support found about 2500. I would expect that's fairly likely now to hold now that price is moving up and away from this little consolidation. There's a morning star candlestick pattern here and a bullish engulfing candlestick pattern here. The first candlestick, or the middle candlestick, the star from the morning star, has support from volume. It's a green candlestick, so within that week, upward movement dominated and there is some push from volume. I would have much more confidence though if it was this candlestick which had support from volume, and it does not. And hence the alternate Elliott Wave count. I am open to that possibility. I'm not going to get hung up on one view. The bullish engulfing candlestick pattern does have some support from volume, and it has a pretty good range as well. The volume on this candlestick is higher than the prior downward or red candlestick, so there is some support here, hence the reason why the main Elliott Wave count is the main Elliott Wave count. On balance, volume is also constrained along with price consolidating. The support and resistance line, these are highly technically significant. If we see a clear break above resistance, that would be a strong bullish signal. Likewise, a clear break below support would be a strong bullish signal. Watch this one carefully in coming weeks from on balance volume. RSI in neutral territory, ADX telling us there's no clear trend, plenty of room for a bull market to develop again or for the bear market to continue. At the high, Up here, there was long-term double bearish divergence. Is this pullback enough to resolve that? Is the resulting bear market complete? RSI isn't going to answer us this question. It didn't get into oversold, but if we see a bullish signal from on-balance volume, I'd be really confident it is complete. The bullish engulfing candlestick pattern suggests it could be, but it's not strong enough to be definitive. Stochastics neutral and ATR declining as price consolidates is normal behaviour for any consolidating market. At this low down here, we've got a bullish candlestick pattern. It has pushed from volume, but this is a red candlestick, so downward movement may most likely have dominated during that session, and so we can't really read an increase in volume here as bullish. We could also be bearish as bears dominated. This next candlestick is not a bullish candlestick pattern, and it doesn't have support from volume, giving some concern about this low being sustainable. At this next low, we have a really strong hammer candlestick pattern. It's green, but the real body's so tiny. It does have really strong volume. This looks like a selling climax, which could be the end of downward movement, and price is now moving up and away. But how strong is that up and away? ATR is declining. We have some support from volume for the first piece of upward movement, but after that, overall, we're seeing some declining volume, and now we've got single, although rather weak, bearish divergence between price and RSI after RSI reached overbought, and a bearish candlestick pattern, these three here, an evening doji star. The third candlestick does have push from volume as well, so this is a rather bearish signal. Given that conditions with RSI reached extreme, it's unsurprising we're getting a pullback, and this certainly could continue lower. Look out for next support, about 2,900. Volume is actively pushing lower, and the short-term volume profile is bearish. Volume is actively pushing price lower, and we don't have a bullish candlestick reversal pattern yet to indicate that downward movement is over. ADX hasn't caught up with the change, it's declining, telling us there's no clear trend. The prior downward trend reached very extreme. It was above 40 and above 45, but not as extreme as cryptocurrencies can get, although Ethereum is the least extreme cryptocurrency chart I've looked at. Stochastics neutral and ATR declining as price moves higher. We've been over that. There's some weakness in this upward movement. So for the very short term, my conclusion is more downward movement. For the very short term, I'm leaning toward it's more likely than not that there are sustainable lows here and here, but I'm not 100% convinced. I'm going to look at on-balance volume at this time frame here at the weekly chart level for a signal either way for Ethereum. That's all from me this week, or that's all from me for probably the next several weeks for Ethereum with an update for you. I hope everyone's having a fabulous weekend.